Welcome, everyone. Well, with me to the session today. Today, we are going to be talking about risk management and trading psychology. So, whether you're joining me from the beginner's room of XM Live or you're joining on YouTube, please do well to use the chat box. Ask me your questions, tell me your experience with this aspect of trading, managing your risk and your mindset. How does it affect your trade in the market, and how have you been able to manage it as traders right now? You can let know this, and I will be more than willing to answer your questions if you do have questions relating to what I am sharing in the market today. To start with, let's do a little bit of analysis and take a look at what we have at the moment. I'll look at what I have ongoing, and I'll talk about this, um, what I have on my chart at the moment. I can see my chart isn't showing yet. Hmm. Let me ensure to let them know. All right. So basically, I have three trades ongoing. NZD was a pending order that got activated yesterday, or was it? Yes, later yesterday. It got activated and is still moving at the moment, but I entered GBP USD this earlier, and Euro HUD seems to be the oldest one so far in this. Um, so we have Euro HUD. Let's take a look at that. Euro HUD, I have a sell on this, and you'd see the price is still bearish. This chart template is even on the Mexico. There are patterns that are formed all supporting bearishness. So if I am asked what my bias is, I will still say that my bias remains bearish. Okay, I can see my chart is showing now. So my bias is bearish based on what I can see still, using this Ichimoku pattern template. If I also go to use my other template with moving averages, it's also below the moving averages. Yes, at the moment it's trying to push back in pull, kind of pulling back, more like a pullback. But you would see the major structure is still there. We had this double top at the time. The neckline got broken, retraced, and then it pushed down. Right now, the current candle is looking bullish. I can consider that still as part of retracement, but my bias is mainly bearish, which means I'm expecting the price to go all the way down at some point. All right, so bias bearish still on Euro AUD. Then we have GBP USD. GBP USD, I have a buy, and I'm still holding on to that. There is this pattern here that looks like inverted head and shoulders, or a V pattern. The neckline got broken, retested, and now it looks like it's ready to continue the movement to the upside, which supports what I have ongoing. The buy that I have ongoing is still supported, and yes, I'll hold on to this. If I am just coming into the market, what will my bias be? Still a buy. I'm still going to be looking to do a buy. If I have just entered and just analyzing the chart to find my home trade idea here. And lastly, NZD-USD. For NZD-USD, I did the sell basically based on the major trend on the higher time frame, which is this weekly time frame. There is this head and shoulders there, and then ascending channel. The price broke down. However, for this week, I see a retracement. It is correcting at the moment. For how long that correction is going to be, I may not be able to tell exactly, but I feel that whatever we have at the moment is just pullback, and that the price will continue down later. So you would see all of this area, this consolidating area, or where the head and shoulder had formed on higher time frame got broken. This ascending channel also had a breakout below it, and the price is now retracing. And after the retracement, what do I expect? That the price will take a bearish move again at some point. Even though at this point too, we have a sort of pattern that looks like a rounding bottom, which also looks like what we have with GBP AUD. And in that case, if it continues higher, can also mean it, US dollar is still weak against most currencies. So I'll leave that and let it be for now and reanalyze later to see whether I still want to hold on to it or maybe I close it manually on my own. So these are the three trades I have ongoing at the moment. Now let's move into the important topic of the day. If you notice, you would see that for all the three trades that I have my stop loss, I have my take profit for all of them. Now, for some people, for me, sometimes I will decide not to put take profit and just manage my position with the trailing stop or so. But usually I will ensure to have my stop loss. Why is that? Because stop loss is quite important for me. The market can turn against my direction at any time. What is important is that there is a safety net in place so that automatically when it gets to a level where I am no longer comfortable holding the buy or the sell, I get taken out. That stop loss is quite essential. A lot of the time, our mind plays us risk. It's kind of plays us some tricks such that you will tell yourself, I'm going to close it. Oh, when it gets to this level against me, I'm going to close it. But then it gets to that level and you're still holding and you're still hoping and you're still, praying and wishing that the market turns against you. And what happens in such case? If you continue to hold on to a losing trade, you may hold on for so long that you blow off your trading account, kind of losing the entire capital that you're trading with. That won't make a lot of sense for you as a professional trader, losing your capital just because you choose that you're going to hold on to a losing trade. But this do happen. And if you look at it, for some people who have realized it and beating themselves up for it, they still make the same mistake over and over again. Why? Because they choose not to set the stop loss. And instead, they believe that they can monitor the trade and ensure that it doesn't go against them again. All right. So the important thing is that you cannot all the time um, follow that rule and manually close your trade when it is going against you. There are times you'll still be hoping. There are times you'll still be wishing and you know that it turns against you and you still be telling yourself, let me leave it a little bit more. Let's just see what happens a little bit more, and it gets too much. And by the time you're closing it, you probably would have lost more than you planned. Perhaps you're looking at, okay, for this trade, I'm not going to risk more than 2%, and then the market turns against you and it goes 2%, 3%, 5%, and you're still holding. That is also still risky. If you do not want to risk more than 2%, but now you're risking 5% because you were hoping and wishing and the market kept going against you and you ended up closing it at 5%, what happens? That means that the next trade that goes to profit, which perhaps is giving you maybe 3% because you have 1 to 2 risk to reward ratio. Maybe it's giving you 4%, and then that's not enough to cover the 5% you've lost before. So this is why risk management is important, and the little things like your stop. Now, how do I set that? For someone who is new to in the market, you probably will be wondering, with this stop loss, where is it supposed to be? How do I determine where my stop loss is? A lot of people there are different ways you can choose your stop loss. Some people use ATR. ATR is an indicator, you know, average true range, which kind of gives you the average range of the last few candles and help you understand the range of whatever market you have on the average. Let me add that to the chart. So that's it, the average two range. So this is it down here. They can use this to determine where their take profit is going to be. The current average two range is 16.8 pips. All right. So some people will say, okay, I'm going to take times two of that, times two of the average true range, and then multiply the 16.8 by 2. That's, let's just say 17 by 2. That's going to be give them 34 pips. So you can say, okay, I'm going to enter this trade, but I'm going to do 34 pips stop loss. Some people determine their stop loss that we're using the average true range, where the HCR is at the moment, the number of pips it's given at the moment can give an idea of the average range and can give an idea of where you can place your stop loss. That's what some people use. For me, I prefer to set my average based on a high in the past or a low in the past. So I was entering the trade. It was a pending order. I think I set for when a pullback happens for me to enter and continue the price down. And my stop loss, I place it below. There was this eye here. After this breakout, you'll see the price retraced a bit. So my stop loss, I place it above this eye, which is here. So usually for me, I look at the last eye, resistance in the past. Let me see if I am still. Okay, so you can see this. I entered here for Euro HGD. My entry was here. And where's my stop loss? This was the last eye at the time I was entering here. This was my last eye. And see, the stop loss is above that high. I won't place the stop loss directly by that high because I believe that the price there's a possibility for price to come down, to come back to that level. But if the price goes above it, then the market is changing direction and it's likely not going to be bearish again. It's likely going to change into an uptrend because that's a higher high. A higher high is a characteristic of an uptrend in the market. So if I am having higher high, the price is closing above my last high, then in that case, the price is moving to the upside. So rather than me placing my stop loss just by this eye, I give it some pips and I keep it higher so that the price, when it gets there, if it goes higher above the last eye, which shows that it is now moving into an uptrend, then I better go out of that market because in that case, it's not following the rules for the sell that I already have anymore. So I prefer to be out of the market and go make my decision later, right? So that's it. So I usually will look for the last eye in case of a sell. Why? Because in a sell, I'm expecting the price to go down, and that's why I'm entering and I'm doing a sell. If the price, instead of going up, then instead of pushing to the downside, now start to move to the upside, then I want to be out of the market. So my stop loss is going to be above the last high. Yes, I know that there are situations where the market will come, just test above that high and start going again in my direction. More like a fake break, what majority of traders call fake break, happen a lot of the time. But this doesn't matter. These are expected. I am not looking to make 100% wins in every trade I take. I already have programmed my mind that there are going to be losses. And that's why a stop loss has to be set. It's very important to understand that for every trade you enter in the market, you're risking some money. Okay? You are taking a risk for every single trade you're taking. It comes with its own risk. You have to accept that. And that is why a stop loss would be set. If you believe in your mind that, for me, I can't lose money, the market can't go against me, then you won't need to set a stop loss, right? But understanding that for every trade you take, each trader faces the risk of losing money on each trade. Even the most successful trader, they will lose money from time to time. You would hear a successful trader telling you, my win rate is just 50%, and you're wondering, How is this possible? You're just 50% and you're still considered a successful trader. Why? This is because this trader, when it's making money, it's making something bigger, even though it's 50% of his trades that are profitable. But this 50% that are profitable are giving him 3 rewards to 1 risk ratio, 4 rewards to 1 risk ratio, minimum of 2 rewards to 1 risk ratio. What will happen? Imagine someone who trades